Real mortgage questions. AI answers. One broker who tells you what it actually means. I'm Edward Brady, a chartered financial analyst and broker at eXp Realty. Opinions are my own and not that of eXp Realty, its management or staff. This is Mortgage Questions. Let's get into it.
I found this next question really interesting as people are asking, like, when do I use an assumable loans? In the past, as an investor, no, you really can't necessarily do that because you're not going to live there. But when can they be useful? I mean, when are the fact that somebody has an assumable loan, like an FHA or VA loan, when does that become a benefit to the buyer or the seller? And
although that's not something I personally can help someone assume a loan, typically when someone's looking at assuming a loan, that's usually through the servicer where that loan is being serviced from. But where it might make sense for someone, and I could just talk about one of my agents out in Temecula area in California. She has an unfortunate situation with her clients where they have to sell their home. It's a VA loan and the rate is amazing. It's a 2.5 or around 2% and their solar is paid off from the property. So it's an amazing property itself. Assume this VA loan and have an amazing mortgage payment that will help them with their cash flow and really helping maybe add that extra cushion or that margin to their lifestyle, to maybe their savings goals or their investment goals by assuming a lower interest rate than whatever the market rate is. I think that's great. Someone could leverage that assumable loan because it's maybe lower than whatever the market rate is. Again, it might be different than the time than whenever someone is maybe hearing this, but you can't really get better than those rates.
my understanding is that anybody can assume that loan, not just a veteran at that point. I know it definitely adds value because I tried to buy one and everybody kept bidding it up. I was a veteran, but somebody was willing to pay 50 grand more than me because it had that low interest rate. We talked about when they're great, but what about when they're great in theory, but they really don't work out in reality? What's the deal killer for assumable loans?
Say the loan is $400,000, their purchase price is $500,000. Whatever the difference is, you would still need to make sure you're going to be able to cover with your liquid assets. But sometimes also with assumable loans, it might not make sense because the gap of whatever the loan is that the seller has it as versus what they're selling their home for might be big, and it doesn't make sense because it's taking away from a lot of your liquidity. Sometimes if, where it's maybe smaller, where you could cover the difference and you'll still have reserves in your liquid assets, it might make sense in that way too. What I mentioned would be a deal killer because although the loan amount that you're assuming and the interest rate you're assuming at is a steal, if what the loan amount is compared to what they're selling the house for is too much of a gap for you to cover.
The deal killer is when you have to put too much down because the market's gone up, right?
Correct.
So they put zero down, but now it's gone up 200,000. You got to bridge that gap.
Exactly.
Yeah.
So that would be a big deal killer for a lot of people. In some cases, I think for most recently, my agent out there in Temecula area, it might not be so much of a deal killer because I think what they got it recently a past few years ago. So they don't have a lot of equity in the property. So the gap is smaller. I think it was anywhere from maybe 30 to 50,000. That might be more doable for someone than maybe something that's 6-figure